Hello dear traders. Last week trading in the stock market was quite sluggish despite the publication of inflation figures. The key indices showed just an insignificant movement which turned out to be mixed. This means that investors do not understand how the market situation may change. The beginning of the week was also calm. However, the FOMC meeting that is scheduled for this week is likely to boost volatility. Investors' reaction could be strong if the Federal Reserve resorts to even more hawkish measures in response to the inflation acceleration recorded last month. Most analysts suppose that the Fed will keep the key rate at the current level. At the same time, they will search for hints about the regulator's actions after the meeting, especially concerning a possible key rate hike. Stay tuned. The financial world is always rich in surprises and interesting events. Watch the video up to the end and share your opinion in the comment section. The stock market closed the previous week in the red. The largest drop was recorded on Friday, which could be mainly explained by options expiration. In addition, the latest macroeconomic data unveiled last week confirmed a rise in economic activity. Nevertheless, the inflation issue is still on the agenda. Such a situation resulted in a higher interest rate and real yield, as well as US dollar appreciation. By the way, climbing oil prices continue to intensify inflationary risks, which has a negative effect on the stock market. The expiration of the JPM collar on September 29th is a significant options event that could also shape the market sentiment. Early this week, investors paid attention to the US debt issue. Jeffrey Gundlach, an expert in bonds and other debt related to investments, predicts an increase in the supply of government bonds. However, he does not exclude that a possible recession will widen the federal budget deficit. At present, speculators are shifting their attention to the Fed's meeting. It's highly likely that the central bank will keep the benchmark rate unchanged. However, it may signal a further rise at the following meetings. What's more, officials may not even drop a hint about the key rate cut. According to the benchmark interest rate futures, after analyzing the August inflation figures, traders with a 97% confidence assume that the Fed will leave the rate unchanged at the next meeting. In November, the likelihood of the 25 basis point rate hike to 5.75 per annum is 39%. A jump in US inflation may force the Fed to switch to more decisive actions in the near future. It is possible that at the meeting in November, the Fed will start preparing markets for a new increase in the benchmark rate. Last week, the Dow Jones increased by 0.12%. Although it is an insignificant rise, it still reflects a positive trend. For comparison, other indicators entered negative territory. The Dow Jones opened a new trading week with a slight increase. However, this is of less importance because of the macroeconomic events this week. On Wednesday, the Fed will disclose its final decisions and recommendations, which will cause higher volatility. Notably, we will hardly see any decision that may change the overall trend. The Fed's updated set of economic forecasts will be presented in the form of the latest dot chart, which anonymously shows where rates are moving according to FOMC officials. Judging by various comments, even from the most radical officials, most of them are likely to switch to a more stable rate by the end of 2023, thus signaling a peak. Risks for stock markets will appear if Fed members do not signal the possibility of rate cut in 2024. Meanwhile, the S&P lost 0.16%. Judging by the technical picture, the indicator may approach the level of 4,210. The S&P has long been trying to surpass 4,550, but on Friday it dropped below it. Excluding short-term movements, last week the indicator reached its high. What's more, last week the short-term uptrend was violated and the index slid below 4,465. Now the key support levels are located at 4,430 and 4,420. If the index breaks below 4,430, it may fall to 4,200 or even deeper. In fact, such a correction has been expected since June. As for long-term trends, the S&P may add 25% in the next year. The Bank of America is sure that the US stock market has every chance for considerable growth. Analysts at Wall Street are relying on all-time lows when making forecasts for relatively long-term market growth. This reflects general distrust and pessimism. However, experience shows that such a high level of skepticism is usually followed by impressive profit figures. At present, most analysts suppose that during the year, the market will show a noticeable rise in profit. Long-term profit growth for the S&P will be approximately 7%. This figure could be compared to the ones recorded in March 2020 and March 2009, when the market showed a rapid rise after the crisis. Last year, economists had foreseen profit growth of 11%, while the real change totaled 12%. The NASDAQ 100 manifested poor performance by losing 0.39%. However, at the onset of the new week, it advanced like other indices. Despite this fact, bears remain active. That is why analysts anticipate a negative trend. Investors should pay close attention to the level of 15,150. If the index downwardly breaks this level, it will enter bearish territory. In the event of this, the target will be located at 14,670. If the NASDAQ breaks this level too, it will fall to the next target near 13,300. Thus, the index may return to its initial level of 12,750. Switching to the corporate sector, we see that Apple stocks added almost 2% at the beginning of the week. The rise could be explained by the anticipated release of a new operating system, iOS 17, for the iPhone. Stocks of the energy companies advanced thanks to a jump in crude oil prices. Meanwhile, the consumer lending sector suffered the most significant decline, primarily due to a fall in Tesla shares by more than 2%. As for other corporate news, the rating of the manufacturer of microchips, Micron Technology, was upgraded to buy from hold, while the rating of the digital payments company PayPal was lowered to market perform from outperform. Last week, all eyes were turned to the ARM IPO. The British chip design company was estimated at $45 billion. This is the largest IPO this year. ARM's IPO price was $51 per share, which is the upper limit of the price range. Curiously, ARM technology solutions are used in 99% of smartphone microprocessors worldwide. In addition, the company aims to expand its presence in such fields as cloud technology and the automotive industry, where it has yet to take a leading position. However, the hype around ARM shares subsided. A drop on Friday and Monday suggests that some investors have already locked in profit. At the start of the week, their shares lost about 10% of their value. We continue to monitor the market situation to keep you abreast of the latest news. Subscribe to our channel and leave your comments. We are working for you, making the most relevant video reviews every day and every week. That is all for now. See you later.